Hi, I'm Malcolm Graham-Wood, and I'm here at Core London TV for my CEO interview. And today I'm actually lucky enough to have Executive Chairman of Kistos. Andrew is a regular here, and he's been here before. So, Andrew Austin, welcome. Nice to see you again.
Always a pleasure to be here, Malky.
And you. Lots to talk about. You've just announced a big deal. After, to be honest, a bit of a break. We missed you for a few months, but I'm sure we'll get onto that. Why don't you tell us all about the deal that you just announced?
Yeah, sure. We bought into an asset, into a company called Mima, which is in the Norwegian area. It's a non-operated company. The operator of all of the assets is Vår. And we've paid up basically $111 million in assumed debt for this business, which gives us 24 million barrels of 2P and quite a lot more barrels of 2C, and I'm sure we'll probably get onto that as well.
Yeah. Historically, you've never been sort of deemed to be over keen on buying into Norway, and so just two questions there, if I may. First of all, Mima, certainly the word on the street is that it was getting into some difficulty, and secondly, you've never particularly wanted to get involved in Norway.
I'm going to answer the second question first, because you've clearly been put up to that one. I think establishing a business in Norway is something that we always said that we wouldn't do, because it takes a long period of time. There's a big social contract attached to it. It has, a lot of money invested in just getting a presence, even for a non-operated position in Norway. The advantage in this, in part because this was a distressed situation, is that actually we can shortcut some of that, and a lot of that expense has already been incurred, and then we're able to take that on from that position forward. To the second point, was Mima in trouble? Yeah, I mean it's had a checkered history. I mean it had the selling shareholder is Blue Water. Blue Water were looking to withdraw from a number of their oil and gas investments, and Mima had outstanding Norwegian bonds which were trading at a significant discount. Because the project has taken longer to get going than was anticipated, and it's cost more than was anticipated. And when you've got borrowed money and those two things are working against you, life can get very, very difficult, especially if your equity holder is saying, I really don't want to put any more money into where you stand. So that created an opportunity for us, and we feel that the hard yards have been won actually on this development now, and we're very much looking forward to having the sail away very shortly, and having the platform on the FPSO on station and hooked up as soon as possible.
Yeah, and the valuation, which I mean, people have been talking about $4.5–5 a barrel. I'd like you to address that, but also sometimes on occasions like this, the operator will come in and swoop for the rest of the license, which couldn't happen here.
No, and it couldn't happen here. Well, I mean, I think, again, to answer your second question first, in Norway, customer practice basically says that you can't own 100% of a license. So the seller originally to Mima, or one step back from Mima, was Vår, or the predecessors of Vår. So so that's why Vår couldn't come in now and take the license on. So what we've done, I mean, Vår's valuation, actually there's an interesting piece out there by Mark Wilson at Jefferies recently talking about that they feel that Vår is significantly undervalued at $8 a barrel, a 2P to EV to 2P ratio. Now we've bought into this at $4.75 a barrel. If you like, you can almost think of it as a subsidiary of Vår, but for half price.
I think that's very fair, and of course you'll be starting straight away production-wise.
We get 2,000 barrels a day right now. It steps up once the vessel is on site and the wells are hooked up. The bulk of the wells for the first stage of, or the latest stage of Balder production have already been drilled, or the top holes have been drilled, and they're going to go re-enter them in the summer months to drill the bottom sections. But a lot of these have already been drilled, ready for the hookup. The vessels in the yard. Vår put out some guidance yesterday, which said they still expect sail away to be before the end of 2024, and first oil before the end of 2024. We've structured the transaction in a way that we're protected if that date slips again for another 6-9 months, in the way in which we put a contingent payment in there to the bondholders. So that gives us a means of sort of protecting ourselves against a further delay on that front.
And scale-wise, if that came on as you were expecting, it would put you up there with the leading producers in the UK independents.
Yeah, I mean, we'll be north of 15,000 barrels a day across the portfolio. That's an improved position from where we are right now. But it also gives us this diversity, not only in location, in that we're now in Norway as well, and that gives another place to hunt for future transactions. But also, we have put some oil now into the mix as well. It's low carbon oil. The FPSO is set up in such a way that we can attach it to shore power subsequently.
And just before we finish that one, the King discovery within the portfolio?
We've not built that into the pricing of anything we've paid for. So that's what I mean. There is a lot of 2C in there. And I think it's also important to remember that this is a vessel that was built originally as an FPSO. It wasn't a conversion.
Right.
It was taken off station to uprate it for putting back onto Boulder X. And a lot of money has been spent on this. This is not a vessel that's going to depart quickly. This is going to be out there until the 2040s. So, normally 2C is a bit of promise, etc. But here, this vessel is going to need that drilled up to justify its existence right out to 2042. Yeah. It's not surprising people haven't committed to drilling those wells right now, because until the vessel's out there and it's hooked up, you're not going to commit to that.
Yeah.
But we and the operator do have an ability to extend the rig contract post the end of next year to continue drilling if the partners are comfortable with the progress to that date.
Good. Low carbon, your low carbon credentials have always been right at the top of what people you say about Kistos and where you're going to go. How does this deal affect the...
Well, it's higher carbon than, firstly, it's oil, not gas.
Yeah.
And secondly, it is higher carbon right now, but there's a roadmap to get it sub 6 kilos a BOE. That's through shore powering. Yeah. And I think everyone's comfortable, with Johan Sverdrup and things like that and other developments that are in Norway, that if you're going to produce oil, the Norwegians are probably going to produce it the cleanest way you possibly can. And so I think in terms of having an oil development, Norway was definitely the best place to start.
Yeah. And I was going to ask later on, but might as well do it now. You'd started off a while ago being primarily gas. A deal brought in quite a lot more oil. You've now got, presumably, with the third country that you're in and so on, you're less worried about whether deals are gas or oil, especially with the price of gas having come back quite sharply.
Well, we had a lot of volatility on gas, as we all know, and that has made it difficult, and I'm sure this is something you're going to come on to, but it's been made it very difficult to originate deals in the UK and in the Netherlands in the same way as we have, because of that volatility in the price and the volatility in the fiscal regimes that we've had to deal with. So, yes, we will continue to look at oil. We're very close actually to doing an oil deal in the UK, but the fiscal instability meant that we couldn't go ahead with that.
Sure enough, the UK and Dutch tax situation is my next question. So I'd like to pull that together by saying, obviously, you've mentioned it to a certain extent already, that you've been put off a number of deals by the tax situation. You also said that there are still good deals around and about. So, you're still looking, and
we're still looking in all three jurisdictions, but we definitely see there's more stability in where we sit in Norway than there is in the UK and in the Netherlands. We had 2 changes in a year. We had an outlook that said that once prices return to normal levels, that EPL would be taken away. That was on EPL 1. EPL 2 then extended the date and took away that clause that said that it would drop away in that event. And then we've had some interesting comments from the Labour Party as well.
Yeah, I was going to say.
Which makes it very difficult. So if you're trying to plan for something that goes beyond the time of the general election, being responsible to all our shareholders, we have to take into account what they're saying. And Rachel Reeves has effectively only made 2 tax promises. One is that they will take away resident non-dom status, and the second one is that they will take away investment relief on energy profits levy. And even although some people may say, well, you can't get retrospective taxation, unfortunately, she can now turn around and say, well, I did actually tell you I was going to do this, so you should have built that into your plans. So that makes things that go beyond the date of the election very difficult. We're benefiting right now on our drilling programs in the GLA area from EPL, and that's taken down the net cost to Kistos significantly on that. And I'm sure you're going to come on to Ben Riach in a minute. But in terms of planning stuff that goes beyond that date, you have to take into account that allowance could drop away.
Yeah. I don't think we can talk much more about that. The Dutch side of the tax problem still exists.
The Dutch side of the problem is different in that it does have a floor price, and actually the gas price right now is trading below the floor in Holland. So the Dutch, what's called signs, is a 65% royalty, which effectively applies above around 47 euros a megawatt hour for gas, and gas is trading sort of about 40, 42 right now. So it is a problem because effectively you still have an asymmetry, because if you make money, it's taken away from you, and if you lose money, you still have to deal with it. So none of these things is perfect right now, but effectively it means anything you do, any drilling decisions you make, and any investment decisions you make, and any acquisition decisions you make are are majority driven by the tax treatment. Because it's the largest part. In the UK a year ago, we were taking home 60 pence in the pound of everything we generated. We now take home 25. And the gas price is lower than it was then.
So let's go on to one of the good news, the good projects that you've already signed. I'd like to have a look at the Greater Lagan area, which is exciting. You mentioned the Ben Riach well just now, but why don't you take us through it all together? Because there's a number of key processes there. We've got, what's the production like? Where
the production is reassuringly boring. Which is exactly what you want. We've got Edredor West, which is going to get hopefully FID'd shortly. You've got Glendronach, which again probably will now follow Edredor West, whereas previously it was going to be ahead of that. And then you've got Ben Riach, and this is a very high impact well. I mean, this completely changed the position of the company if this comes in.
That's drilling at the moment. How long is
It's on a dry hole basis. It's estimated to be 118 days. We are currently on about day 37, 38. We're currently ahead, but then that's often the case early on in the drilling. You can get down the early levels of casing quite quickly. So we're currently ahead of schedule on that, and it's very exciting. And I know we're not, people don't generally look at Kistos and didn't look at Rockrose as an explorer. And that's right, because we're not an explorer. That's not our business. But if we get these options in packages we buy for nothing, and as in the case with Ben Riach, we are benefiting from the 91.5% offset in terms of the cost of drilling that for us. The net to us is extremely low, and we'd be very foolish to not press ahead with that. So we'll see what comes of that, because if it does come in, those will be some of the cheapest barrels you've seen.
Now, just before we go away from that, you said that Glendronach's running behind the other one now. I had FID for Glendronach later on this year. Is that now?
It could slip into next year.
The other one's coming in
probably earlier. So there will still be more gas and more flow through the Shetland gas plant.
Well,
don't forget the role. Don't forget the role also of Shell buying into Victory. In terms of that extending the life of the rest of the GLA area. So the GLA area is driven by actually the throughput that goes into the Shetland gas plant.
You have a tariff income from that, no?
We will do at the Shetland gas plant, but the benefit to us is greater than that. The benefit to us is that if you can keep the Shetland gas, the cut-off in that area is not driven by the reservoir, it's driven by the throughput of the Shetland gas plant. So if more things are coming through the Shetland gas plant, we can take more of the tail in of the production on the other assets.
Makes common sense, doesn't it? Elsewhere, Q10A, people ask me about that. And
Q10A, the Dutch production, we put out an RS a few weeks ago saying, it was mixed, and it is mixed.
Yeah.
What we did was we drilled out of the existing wells that have been in place, that were there when we bought the asset. And they are quite complex because the original owners were trying to get the maximum bang for their buck on day one. It probably would be more expedient for us to drill new wells rather than trying to keep reopening wells that were there. We've got third-party peer review going on that right now to work out what the right way to do it is. We know that the molecules are there. We know we can produce them. It's just we haven't found the most efficient way of maintaining that production at the right levels. I'd say now we've got it much more stable than it was before.
Yeah.
The recent drilling campaign. It was declining quite quickly, and I think it appears to be a lot more stable now. It's a question of what we do to access the other molecules that are there.
But it did have a few problems in the end, those Dutch assets and the drilling and so on. You're happy with the fact you
I think we've got our heads around it now. Yeah. We're sort of 18 months into owning it, and we've got our heads around it.
So for the rest of the year, the Dutch assets look like they're
just trickling along,
ticking very, very nicely.
They demand more time and effort than what's going on in the GLA, which is why I described that as the sort of reassuringly boring. Until Ben Riak comes in.
Yes.
And then it really won't be boring at all.
No, that won't be. No. I wanted to spend a bit of time, we've mentioned it once or twice already, about your strategy in general. You've mentioned, to a certain extent, gas and oil, the preference for either, but how it comes up, particularly in Norway, where you're clearly going to be more interested for the reasons we've talked about. And you mentioned tax. We haven't talked about hedging very much. As far as I see it, you're in a position where you basically follow the market. Is that right, or are you?
We follow. I wouldn't say we follow the market. I think we follow what opportunities we see out there.
Yeah.
So if we see something that works in the UK, we'll do it. If we see something that works in the Netherlands, we'll do it. And if we see things in Norway, now the advantage now is we've got a starter pack in Norway, of assets that and a team which was set up expressly to do BD in Norway.
Yeah.
So we have an entry now to do that.
Yeah.
There are actually quite a lot of stranded assets now where someone owns 10-20% here or there, has funded it through a discovery, and isn't really set up to take it through into a development. And so we will be looking at a number of those now we're through the door. We couldn't do that before last week because we could look at it, but we couldn't talk about it because we hadn't announced doing the deal we've done.
No.
But if we can't find the right things to do, we'll return money to shareholders.
Yeah.
And we've done it before, and we'll do it again.
Yeah. So I'd mentioned I put dividends in. Ironically, they always keep coming up just after you mention them, but I wrote in my article after this deal that I thought that the obvious thing to do would be, once you've completed the deal, pay down the debt, then you're back into a position where you can pay dividends to the shareholders, and everyone knows that you're a very substantial shareholder yourself. Would paying down the MEMA debt be?
We wouldn't pay, if we paid down debt, we wouldn't pay down the MEMA piece first. We'd pay down the Dutch piece first. Because that's where
you always had plans to sell the do the Dutch debt.
Yeah, and that remains in place, and that the date on that is sometime in May.
Yeah.
So that's the first thing you would pay down, because you'll also notice on the MEMA debt, some of it is PIK interest, but some of it's cash interest.
Yeah.
So actually, the cash interest cost to us of keeping the MEMA debt in place is much lower than the interest cost of doing the Dutch situation.
But under the sort of rules, you had to pay off the Dutch debt before you could pay a dividend.
Yes.
What's the rule about the MEMA debt?
There's no such restrictions.
Right. So you can still carry on living with all the Norwegian debt and pay dividends. Right.
Pay dividends.
See, that's important to the.
All buy shares back.
Yeah. And over the years, in your various companies, you bought shares back, or sometimes buying shares back is more difficult because of the amount of shares that you've got yourself. But
I mean, we wouldn't hit that threshold for a bit, but I think it's a balance as to which one you do. But that's still very much on our mind. You know, we were very vocal about other people not necessarily having the right debt equity mix. You know, sitting there with net cash of 5 million right now is not the right mix for where we stand. Yeah, we need to have some debt in that mix, and so we will sort that out.
And yeah, I mean, you've always said you need flexibility, and it's only a question of, you know, being in a position where you were able to pay the shareholders' dividends or buybacks. And when
what's wrong is sitting on cash for long periods of time and not deploying it.
Yeah.
And if you can't find somewhere to deploy it within reasonably good order, then you should return it to shareholders. It's their money.
Yeah.
And you know, you need to treat shareholders like grown-ups. You know, I mean, if you say right now I can't find something to use this for, and if you come back to them in 18 months' time and say, actually, have I got a deal for you? Then they will come back to you and say,
we've
you
done
can have
it
it back. And I've done it before.
And you've got form on that front, so it's not
Exactly.
as if people aren't going to do it. So what have we missed out on? You've got there's still plenty. You still think there are plenty of deals around, with the caution on the.
I think there are deals around to do. I'm glad we've got another province that we can actually go, you know, another pond we can go fishing in.
Yeah.
Because I think that's important. I don't rule out going anywhere else either. Deals in the UK and having certainty of things that are in our control rather than things that aren't in our control. And you know, this is where being a significant shareholder really matters, because if I'm sitting here doing this for my salary, I can go off and do all sorts of things. And look clever and then turn around and blame the tax man when it all, you know, the economics have gone wrong. But if I'm looking at it from a shareholder's perspective, I've got to look after that money and judge those risks in exactly the same way as I judge the mechanical risks of a development and as I judge the subsurface risks of a development.
Yeah, I mean, I don't want to go into politics too much. I mean, because you mentioned what you think Rachel Reeves has said already. I mean, you know, there's a good sense of feeling that, you know, if you had a meeting with her, you could persuade her that not that she didn't want to have the tax in place, but she wanted to have something that was effectively so good for the economy that you'll be producing, you know, tax for the exchequer anyway. I don't think you're going to be lining up outside Labour Party headquarters waiting to talk to them about it. But you could explain to them.
And you know, we have as an industry, we have lobbying groups that do exactly that.
Yeah.
But we're not finding, though, the ears, particularly on the Labour side, terribly listening at the moment.
Yeah.
And I think on the Conservative side, you know, there's been talk of things happening, but we still anxiously wait some updates on where that sits.
Yeah. So we're nearly done. Normally I'd just say, where are you going to tell me that you think that the company will be within 12 to 18 months? Today, thank you very much. You've been able to tell us that you've got a new leg of the business where you'll be doing quite a lot of it. How would you summarise putting this deal to bed and looking forward?
Putting this deal to bed is actually going to be very quick compared to a lot of deals. So we expect this to complete in 6 to 8 weeks.
Right.
So this is quite quick in that sense. So that's good news. You know, the team and I are going to be in Norway beginning of next week to have meetings with the operator and with the team and with the ministry. So that's moving apace. We are already looking and reviewing other acquisition targets in all 3 jurisdictions that we're currently represented in, and a couple of others.
Yeah.
So we will continue to review those. But as I say, the tax part of that is now as important as the mechanical and the subsurface part of that. And we need to get that right to make sure we do the right deals for shareholders. Do I think that we've done the right deal here? Yes, I do. We've bought effectively a position at half the price of the operator trades at. So to me, that gives you a pretty good indication. This is pretty important to Vår as well. You know, for every 10,000 barrels it is to us, it's 90,000 barrels to them.
Yeah.
And you know, that's a lot. So that's exciting. And don't forget Ben Riach.
Nah.
Don't forget Ben Riach. That's all quietly going on in the background up there.
Well, if we don't go away from this interview with thinking about anything else, we'll have Ben Riach.
Well, I think you should think that there are a series of, you know, some very regular cash flow coming out of the GLA and out of the Netherlands.
Yeah.
There's some exciting stuff going on in Ben Riach. There is some exciting FIDs coming ahead in other discoveries like Edredor West and Glendronach. And You've also got the timing of the sail away of the FPSO and a significant uplift in our production and our horizons by being in Norway.
Brilliant. Thank you very much for coming in.
And if we can't find anything else, we'll give everyone their money back.
Well, there you go. It doesn't get much better than that. Thank you very much for coming in. It's
Always
been
a pleasure.
great to see you. The loyal band of people who love what you do have been desperate for you to get back in front of the cameras again, for which I'm most grateful. Thank you very much indeed.
Thanks, Malky.
So I've been Malcolm Graham Wood, and I've enjoyed doing my CEO interview here at Call London. But today my guest has been Executive Chairman of Kistos, Andrew Austin. I'd like to thank him for coming in to see us and talking to us and through the latest deal. And I'd like to thank you for watching. Thank you very much indeed. Goodbye now.